On today's show, 3 questions. Number 1, how should we analyze election betting data? Number 2, is your portfolio immune to E.Coli? And number 3, are you prepared for the great wealth transfer? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Rabih, 2 weeks in a row, just you and me. People should not get used to this, I don't think, where this is just time of year. It's hard to get everyone on together. We're all in the middle of year-end calls. And so we kind of decided to give the other guys a break and just say, go help change some lives and do your year-end calls. So it's just, they're stuck with us for right now.
Yeah, I don't know if they're doing it on purpose, but there's a client meeting scheduled on everyone's calendar during this time.
Always during this time. You know what? We'd rather do that. We'd rather be taking care of clients. So I don't blame them at all. But let's jump in. We have to prepare the people, Rabih, because before we got on, you had said to me, you were giddy. You were literally giddy, so excited. And you said, this is the most excited I've been about a topic ever since we've been doing 2 cents, which is a big deal. It's a big deal.
I feel guilty.
So let's talk about it. How should we analyze election betting data? You said it's bigger than that. That's not really what got you excited, but this is kind of like the lead in to the bigger topic.
Yeah. This is more of a Trojan horse for me to talk about math.
Here it is. This is like every time we have a meeting, it's a Trojan horse for you to talk about math and whiteboard something.
I know. It's so fascinating. Well, I'll give you a summary once we finish talking about it, and you then tell me if it's not eye-opening about how we think of our world and around us. But to motivate this, to like get it started on its feet, last week we had a client at the office, and it's just a regular client meeting, and he actually asked us, doesn't the market tell us anything about who's going to win the elections? Like, can't you look at data that other people are not seeing through polls or etc.?
Just tell me what's going to happen.
Tell me what's going to happen. It's people avoiding uncertainty as usual. And then yesterday there was this CNBC article saying that a French trader has bet over $28 million on Trump election win using 4 Polymarket accounts. And I got excited. There's a lot of money flowing around into these betting websites, especially Polymarket. It's the largest one. So I was like, let me go in, let me take a look at it. Let me see whether there's any type of information that we can take out of it. So I went into the website, and just to preface it, there are 2 types of information over here. There's the information of what the people who are betting in favor and the people betting against have, and there's the information that the dealer has, the house. And usually the house has a much bigger incentive to be correct than the participants in a betting game. And this is the same in like a casino. The casino really has an incentive to be correct, or they're going to go out of business in Vegas, right? So it follows the same logic. In the stock market, brokers have an incentive to have models about stock price movement much more than the buyers and the sellers, the bulls and the bears. So this same logic continues.
And just to clarify, you're saying the dealer is the one, or the house, like in Vegas, or in this case, the Polymarkets, the house is setting the odds. So they're using their information to say, here are the odds we're going to set to kind of try to control the flow of money one way or the other.
100%. Because the way they make their money, once the event happens, they share the money with people who bet in the correct way, and they take money from the people who bet incorrectly.
Who lost.
So if there's a lot of people who bet in the right way and the house wasn't on the right side, they pay out more than they gain, and consecutively they start losing money. So let's start with a very simple example. It's a simple coin flip experiment. If you get heads, you win $1. If you get tails, you don't win anything. So what is your expected outcome from this coin toss? It's 50 cents. It's $1 times 50% plus $0 times 50%. So in your mind, you would say, I would only participate in this bet if I have to pay 50 cents or less. This makes it either a fair bet. I'm paying 50 cents to an opportunity to make 50 cents, or I'm paying less for an opportunity to make 50 cents. When the bet is completely fair, it kind of means that the broker doesn't have information about the bet. They are not setting odds. They're making it a 50-50 chance.
They're guessing like you are.
They're guessing like we are. They're just letting the purchasers and the sellers kind of determine an odd or a probability. But if I'm the house and I know for a fact, you don't know this, but I know for a fact that the coin is going to come up heads 70% of the time, 70% instead of 50%, I would be inclined to telling you to keep betting, but I would not adjust the price. And by me not adjusting the price, I have created more odds towards me, and I'd be inclined to let you to bet on a tail because I have the edge of hitting a head. So without going into much more detail, when you look at a certain bet and you try to look at the expected profit versus the price to participate, these two, if they are equal, it means it's a fair bet. And if they aren't, it means that it's an unfair bet. There is informational content over there in the hands of the dealer. And this tells us a lot. So I went to Polymarket and I got all the data out of there. And there was 62% in favor of one candidate and like 38% in favor of the another candidate.
But you're saying based on the betting?
Based on the betting.
Got it.
It was a 62 for Trump, 38 for Kamala. And then I calculated what, and you participate if cents, it either gets to $1 or it goes to zero. So when you calculate, if you're betting in favor of Trump, your profit is going to be going from 63 to $100 to $1. Like this is from 63 cents to $1, which is around a 60% return, or it's whatever. So that is your expected profit, and the price to participate has been correctly matched to match the probability. So for you to participate, you had to pay in 63 cents. Thinking of this brings us back to the fair bet example. Given that there are no odds in that bet, the broker themselves have no informational content on who's going to win. They're just letting the market participants play. This is the election part of it. And now is the part of it where I'm super excited about. The part
Giddy.
I'm super excited
he's
about,
shaking.
The fact. So I introduced two concepts. I introduced the concept of your expected outcome, which is the probability of winning times the amount you're going to win, plus the probability of losing times the amount when you lose. And I also introduced the concept of the price for you to participate in. And when you set those to be equal, and this is what they are doing in this example of the election betting, when you set it to be equal to make the odds fair, you are enforcing a mathematical constraint. And this is not a new mathematical constraint. All of the quant trading, quant hedge fund, and how we analyze, how we model stock prices, how we model option prices are all based on this property where the expected payoff is going to be equal the current state of the system or the price to participate in. It's called the martingale, different than the martingale in betting. And something incredibly interesting comes out when you enforce this equality, which is the probability measures that you get out of a system, a betting system, a option pricing system, a system that mimics the stock market, whatever that system is. Once you set that mathematical equality, the probabilities that you are getting are called risk neutral. So I'm going to jump to the stocks. It's funny that I'm going to explain something with the stocks. Usually stocks are the more complicated thing, but it's very interesting to look at. Just like betting with in favor or out of favor or versus for a certain sports team or a candidate, with stocks, you can bet for its movement on the up or movement down. You buy a call option if you want it to go up. You sell or you buy a put option if you want it to go down. The same idea. When you look at option prices, and you can derive a lot of stuff from them, whether it's the VIX, like we've talked in previous episodes or not. When you look at the probabilities that they come out of option markets, they do not match the probabilities that you observe in real life. So there are two measures of probabilities. There is the probability that is implied from our model, whether it is the prices of options or whether it is a betting simulator like the one for elections. Whatever model we have about the world gives us certain probabilities. And once the event happens and we look at the data and we calculate what the probability was, we will have a different probability about the world. In the example of the stock market, you look at calls and bond and puts, you find a different probability. For example, let's say that the probability that stock prices move, what's the move going to be in 1 year? It's usually around 55%, 45% when you look at the calls and the puts. But we know empirically over the last 100 years, an annual jump in stocks, like the odds of stocks versus bonds in a single year, is 70% in favor of bonds. So the probabilities that we derive from the options market, or our model in a sense, are different than the empirical probabilities that we received from real life, from observations. So what this tells us, that there is a difference between them. So the probabilities that we are getting from the betting game, the 63 versus 38, are going to be different from what the real probability is. And the real probability is going to be 100 versus 0 once we get to it, right?
Sure,
Once we know who wins, it's going to be 100 versus 0. So there is a difference between them. And here's, I think, the holy grain. Do you know what makes that difference? Like, you can connect these two concepts of risks, or probability. You can connect the concept of the probability coming from the model and the actual probability that we see in real life. And in the stock market, there is a glue that puts them together, and that glue is risk aversion, and which is the fascinating part, because the model gives us only certain probabilities, and those probabilities coming out of the model are risk neutral probabilities. So let me explain it in terms of stocks. When you are calculating the price of an option, or whatever model we are doing in the stock market, for you to, if it's an option on the stock market, in your math, for it to add up, for the probabilities to add up to 1, right, on both sides, you reduce the expected return on the stocks, which we know is 10% on average on the long run. You reduce it to equal that of the risk-free rate, which is cash, or the T-bill. So the probabilities coming out of the option market, or any model, a betting model, are risk neutral. You are reducing the returns from the stock and the cash to be the same, and thus the probabilities at the end of the day are able to be mathematically coherent. They add up to 1. But this is not real life. In real life, stocks are riskier than risk-free assets like cash and T-bills. And for that reason, because investors are risk averse, they require a premium. We talk about the equity risk premium a lot on this podcast. They require a premium to hold the stocks. An investor would not hold stocks if it's going to give you the same amount of money as bonds do, because then just hold bonds. So the same idea, the fact that there is a risk aversion in real life that is not encoded in the model, deviates the probabilities. So when I'm looking, and here's like the summary. When I'm looking at the probabilities coming out of a betting strategy, and the betting strategy is telling me there's a 63% for Trump, 38% for Harris, this is a probability that's coming out of a model, out of a betting system. And that betting system gives me a risk-neutral probability. Ask any American, any person who's eligible to vote, and tell them, is the risk profile of the candidates, regardless of where you are on the spectrum, the same? Is it the same benefit for Harris to win versus Trump for Trump to win, or is it the same risk if Harris wins versus Trump wins? So because those are different, because our risk aversion as independent voters is completely different, those probabilities are only part of the big picture. They are not real, the probabilities. What's gonna make them expand or compress, come back to being 50-50 or going 98 to 2%, is going to be our risk aversion as investors. And honestly, when you take that framework from the stock market, it blew my mind. Options always tell us certain probabilities. Stocks tend to outperform, and that's usually because there's a risk premium for stocks. The VIX is always high, but when you measure the standard deviation of historical stock returns, they are usually lower. So there is a scaling factor between the probabilities that we get out of models and the probabilities happen in real life. And that difference between them depends on our own human nature of being risk averse versus the risk neutral data we get from models, which
Yeah.
is mind blowing. I hope
I
I communicated
you
the
did.
enthusiasm.
As I say, I love this so much. There's so much to take out of this, but the number one thing I love about this so much is how excited you are about it,
It
and
is
it is
amazing.
felt, and it's amazing. It is. No, but I think this is really critical because this is a theme throughout a lot of stuff we talk about. And I think the thing I'm thinking about as you're going through this and explaining it very well, and you talk about like the key factor here truly just being human behavior, human nature, and that's what makes that's the inherent challenge. I think there's two inherent challenges when we talk about this kind of stuff. Number one is, Rabih, you know as well as I do, like humans, we just don't, and I'm putting myself in this camp, by the way, we don't, our minds don't work in the world of probability. Like, right. And this is so just using it, or in math, like we talk about compounding, like our brains don't work in this way. Right. So I think it's really hard to understand it. But secondly, what you're talking about, I think is so critical is why it's so inherently difficult for these models to be accurate or to be sometimes at the worst case scenario, even be useful sometimes because of the human nature of this. There's the economic models that you're talking about that are factoring in humans being rational actors. And we know humans are anything but rational actors. So it's really interesting. I do want to focus though a little bit. So the takeaway for you on, let's just hit the betting right now, because there's been a lot of talk around the betting with the election coming up. What does it tell you specifically, would you say, with this, what you're talking about here of like the betting right now and these poly markets is showing, and by the way, we're not making a prediction on the election and we don't, we're not getting
We don't
political.
care.
We don't care. But I am curious, would you say, so right now the poly markets are showing 62% for Trump, the betting, is that right?
Yes, yes.
It's just saying a
But
lot of the money's going on Trump, basically.
this is it. This is saying that market participants are funneling more money to Trump than they are for Harris.
Got it.
But this doesn't mean that the House has any information in how they are placing the
This is
odds.
just saying
The
more
House
people think Trump's going to win than Harris in the betting market.
and the betting market, but also just to be more, robust, do science the proper way. You would want to mimic. You want your model to mimic real life, and in real life, only Americans can vote, and every person has one vote. In a betting system, the article is saying it's a French trader who's dumping $28 million. So that is one, and two, because you can bet more than once and you can bet different accounts, it doesn't mean that every single person's vote matters.
Sure.
So I honestly, personally speaking, I do not think betting systems or polls are the proper way to actually model and predict elections. There are
Yeah.
more concrete stuff. Jumping back to explaining stuff through the stock market, because how this is my brain works. When you are trying to model a price of a stock and whether it's going to go up and down, you do not model the actual price because we know it's random. A lot of studies have been random. The outcome of the election, kind of from our perspective as beings who do not have perfect information, is going to be random. But how do you do it? You model the cash flow of the company. You model the products that it's coming up. You try to model stuff that are not random, that follow a certain trend that you can study. The same thing can happen in elections. We had a census happen in 2020, right? It didn't reflect in the 2020 elections, but the census information are going to be reflected in 2024 elections. Because of this new census data, some states lost electoral votes, other states won electoral votes. You have to model how that affects election polls, right? And results. You would model the turnout. You can't predict which candidate will be voted for, but you can model whether people are going to go to the polling stations on election day. Are there major renovations on the roads that make it so hard to cross from one side of the city to another? You can model these mathematically, and then you can try to squeeze out a probability. But based on, games and tools like polls, who it is known that they hit only a certain demographic that's willing to answer the phone, right? Or betting systems that do not have geographical restrictions, we can come up with better tools to predict the elections. These two aren't, but it just seems that the media likes to focus on these two.
Yeah. Yeah. Well, and this, I remember, I mean, in 2016, the things you're hitting on, I think, are really pertinent to this. We just talked about this the other day, Rabih, where in 2016, the polls were so off, right? And there was a huge outcry after the fact of these seemingly, and they were like legitimate polls that were coming out showing one candidate at that time, Hillary Clinton, was far ahead of Donald Trump in the election, or in the polls, in the like leading up to like the night before the election. This is why a lot of people are calling it 2016 like the greatest upset ever in politics. And I think it's what you're highlighting. I'm hearing you go through this, and I'm like, holy cow! And this is my dense, very, very average brain, just being like, oh my gosh, how difficult would it be to actually find any level of precision or accuracy of something like an election, of who's going to win this election? Like, there's so many variables that are impossible to factor in, and the one you're highlighting the most, what it really boils down to, is again human nature, or these polls only get to certain number of people, or certain demographics of people, or the fact that you have to rely on the fact that that person's telling you the truth when they ask you who you're voting for. Like, it's just, it's impossible. That's why I think these polls that are coming out before, it's like anything. It's really fun. It's fodder for discussion around the dinner table leading to the election, but I don't know how accurate, like how much you can actually rely on them.
They only show a slice of the whole pizza. Like it's this is a problem of human nature. We collect data, but we can't really measure and observe the whole thing as a whole. We collect data through a betting system, we collect data through polls, we collect data through statistics, etc. But are you able to measure are you able to read everyone's mind in 1 second and come up with an answer? This is a physical limitation we have as human beings, and this is how we deal with uncertainty of information in the world.
Well, and you just hit it too. The other part of this too, of human nature, of the reason we're so enamored with this stuff. And I admit, I'll sometimes find myself middle of the day being like, I wonder what's going on. I'll like look up the polls just because I'm interested. And I think part of it is our grasp, our need, and our grasping for control in our life. And this, I think the number one fear for all of us is that is uncertainty, whether it be with our money or life in general. We don't like the idea that like we have no control over this. So I think that's why polls, and I mean, how many companies out there, Rabih, how many media outlets like are all based around just polling data? It's unbelievable, because we want this control. So fascinating, Rabih. What are the final thoughts on this topic?
I think if you're going to take anything out of this, is that, and this is why it's bigger than elections, etc. Probability measures that come out of models assume risk neutral behavior, assume that you are indifferent between the outcomes, assume that for you the reward from one outcome is equal to the reward from the second outcome, and the loss from the first outcome is equal to the loss from the second outcome. The fact that we humans are risk averse, we know it, we hate pain, we love winning, and pain hurts us more than benefits, changes the equation, and this is not being accounted for in our current tools.
Yeah. This is amazing, Rabih. So final word on this. So who's winning the election then?
I don't care.
I'm just kidding.
This is what gives me pleasure, understanding how the world works.
You're like, I don't care about the result. I care how we get to the result of all this data.
Actually, a closing thought. Also going back to the stock market to explain stuff. The reason that options have a value. A call option, you have to pay money to buy it. And a put option, you have to pay money to buy it. Whether it's going up or down, you have to pay money to purchase that instrument. Tells you that just having the choice to do something is valuable in life. And having the choice to go and elect someone is valuable. I've elected in elections that the vote definitely did not matter. Not in the US. It was in Lebanon. And it feels different over here because the stakes are higher. It is valuable. The fact that you have a choice, it's something valuable and should be cherished.
I love that. We're gonna end that segment there. It's amazing. Okay, I think the next two will be pretty quick topics. We just thought would be kind of fun. Number 2, is your portfolio immune to E.Coli? This is a good one. Let's talk about this.
And it came at such an unfortunate time because McDonald's finally released their chicken Big Mac in the US, I've been telling the people at the office for years. I kid you not. It's been like 4 years of me telling people in the office that McDonald's in the US does not taste as good as McDonald's outside the US.
Yeah.
And McDonald's in Lebanon has an item on their menu called the chicken Big Mac, which was my whole personality during college. Like, it was so good. It's so good. And I remember 2 weeks ago, they released it, and everyone in the office noticed. Like, Taylor texted me at 1 a.m. telling me that he tried it. You know, like,
It's amazing.
It was such a profound moment for me to finally introduce that product to my American colleagues. It wasn't the same value. It wasn't as good as the one in Lebanon. I have to admit it. It felt more like a chicken nugget instead of a burger. But I was so excited that they're introducing international items on their menu into domestic markets. But it seems that there was an E.Coli outbreak that was first found in the double quarter pounder. What's it called?
Yeah, I don't know. Quarter pounder. I haven't had McDonald's for like probably 10 years.
Yeah, it's fine. And they had to take them out of the market. So far, just the data today, there's 75 people infected with E. coli due to the quarter pounders at McDonald's. It is now being known what is the source of it. It's the onions in the quarter pounder, and it's affecting Burger King, Yum Brands. Yum Brands is like the bigger owner that owns like Pizza Hut, and I don't know if they sold it, but like other chain countries.
It's always the vegetables, you know. It's always the vegetables that are coming to get you. This is why I don't eat them.
But E. coli
Just kidding. I eat vegetables.
E. coli is a disease that comes from animal intestine. So it's just the fact that our aggregation system in the US is messed up. You have so much farms next to agricultural areas that the water is getting mixed up and bacteria is getting across, and there's a cross contamination. So they took it out of the market. But I think the fascinating thing is that McDonald's dropped 5% during that day, the day it was announced. I haven't checked today, but it's probably also down because the number of people getting sick is increasing, and
MCD,
and it's affecting.
It's down another 2.6% today.
Yeah, I think that it was like a 1.7 yesterday, and so there are. I think it has crashed by 8% already in like 72 hours. So this brings us back to like diversification and proper diversification, because this is a company specific risk, and it's growing to become an industry specific risk. Like now all fast food chains, who, because they kind of have similar suppliers, especially when it comes to products that are not valuable for their value proposition. Like I would not expect Burger King and McDonald's to have the same meat supplier, but they'll have the same vegetable supplier. It's economies of scale, right? But because they compete on the meat, hopefully that's the most important part of the burger, you know?
Yeah.
So it's becoming an industry specific risk. But I think, and our listeners know this, we've preached this enough, that you should not be invested in one company because your risk, your idiosyncratic risk, company specific risk is too high that it might harm your portfolio to a point of no return. But also people say, well, I have it as a part of an index. Is that diversified enough? And here's where we come to the point, like not all diversification is created equally. McDonald's is part of the Dow Jones, and the Dow Jones only contains 30 companies. If you look at the day when the information got released, the Dow Jones was lower than the other two indices, and I'm talking about the S&P 500 and the Nasdaq. And not because there's something wrong with the Dow Jones itself. It's just because it only has 30 companies, and the impact of one company on it is too strong. So in terms of immunity, the Dow Jones isn't as immune to company-specific risk as much as the S&P 500 is, or the Nasdaq in a sense. Well, the Nasdaq is a different sector, unless there's E. coli for computer chips. But it's the whole thing. And and that's why this segment is closed. It's like, yes, there is company-specific risk that, dear listeners, you are all aware of. We preach it enough. But also not all diversification is created equal. And it's appropriate. It's important to, when a diversification strategy is being employed in a portfolio, you are making sure you're not concentrated in one stock. You're not concentrated in one sector. You're not concentrated in one size, and you're not concentrated in one characteristic, whether it's a value stock or a growth stock. And also, you're not concentrated in one regional area. So diversification is not just, oh, I have multiple stocks. Diversification is having multiple stocks that are spread over these 4 risks that I just mentioned.
Yeah.
You can create a non-diversified portfolio that has 1,000 stocks in it, but it's still non-diversified.
Yeah, I love that, Robbie. We preach, like you said, diversification on this show all the time, and with our clients, and then when everything we're doing, because it's a simple concept, very simple, not always easy to implement properly. To your point, because I think again, one of the things that people misunderstand at a fundamental level of what is proper diversification, but I think proper diversification and being able to mitigate that risk, like you're saying, whether it be geopolitical risk, whether it be specific company risk, whatever it is, it when you are properly diversified, it makes what could be a devastating, like this story coming out. The difference, diversification is the difference of this story becoming, or for you as the investor, just becoming like a crazy, oh, that's a crazy story, to like devastating to your portfolio. Like you said, if you're too invested in one area of the, or one region or one sector or one company, we if you're doing it right, and what our goal is for our investors and clients is to have this kind of stuff just be crazy stories, like, oh, and you're not even thinking about your portfolio because you're properly diversified, and this would have no impact on your portfolio really. It would just be like, man, McDonald's got an outbreak of E.Coli, which, by the way, you talk about your personality in college being the chicken sandwich at McDonald's.
Yeah.
This is actually kind of connected. I can't really talk much crap about E.Coli or McDonald's or any of this, because my current personality is all based off of my consumption of Chipotle.
True.
And it's not like Chipotle has the best track record when it comes to this. You know what I mean? So, and again, even in Chipotle, I'm telling you, there was the lettuce. So we have a valuable lesson to be learned here, Rabih, that vegetables are a problem.
No,
I think that's what we're learning.
Farms from,
I don't know. I think we could just simplify this down to, if we're going Occam's razor, I think it's just stop eating vegetables. I don't eat what my food eats, Rabih. Okay. the great Ron Swanson said that. No, I'm just kidding. Everyone, I eat vegetables. Okay. I'm not. Robbie's like, I've eaten with him. I've eaten lunch with him. Okay. So I love that. We like to take these kind of, these headline stories and hopefully kind of reiterate these kind of fundamental investment principles. Being proper diversification is a simple concept, not always easy to implement, but it really does save you from stuff like this being catastrophic. Any other final words on that, Rabih?
Eat your vegetables.
Eat your vegetables. Stay away from McDonald's. Okay. So last thing, this will be, again, I think quick. I just think it's a good opportunity, shifting gears a little bit. The question being, are you prepared for the great wealth transfer? First of all, I wanted to highlight the mind-blowing numbers of this, Rabih. I don't know if I think you're aware of I know you are aware of the demographic kind of changes in America, and over the next really 10, 15 years or 20 years, what they're calling is kind of known as the great wealth transfer. The baby boomers are getting older. I think I read recently we have 12,000 Americans reaching the age of 65 every day. Yeah. So the retirement, obviously we've addressed the retirement stuff, and we'll continue to do that over the coming, as we do this show. But the other part of this is, as those baby boomers get from 65 to 75 to 85 and beyond, and then start to pass away, the estimates right now are that $84 trillion of wealth will be changing hands by 2045. That's
around 3.3 times the size of the U.S. economy, which is the largest economy in the world.
Yeah. So 84 trillion. That's pretty wild. Majority of this money going to Gen X and millennials. Right now it stands to reason and makes sense that the baby boomers are the wealthiest generation in America, which again makes sense because they're the oldest and ever of all time. which again makes sense with how innovation and an economy works as we grow, and then the aging, that demographic has aged to the point where they've been able to accumulate this wealth. But then, of course, they pass away, and then that money is then transferred. So $84 trillion of wealth being transferred by 2045. So I think, so first thing I wanted to hit was just that is mind blowing, the number.
Yeah.
But I think the practical kind of takeaways from this. So what should you be thinking of? Like, okay, that's go beyond like just the craziness of that. I think one of the things, the biggest takeaway I take away from this is the importance of talking to your family about money. And when I say your family, I mean having conversations with your parents and grandparents, and not in the sense of, hey, am I going to inherit money? But I think just the importance of like you being prepared of if there's any thought, like if there's any thought you're going to be inheriting money, possibly. I think it's critical to have some communication and be prepared for what that's going to look like for your life, for your kids' lives, and all of that. So I'll stop there for a moment. Rabih, any thoughts you have?
Honestly, this is a really great point because now the amount of money being inherited from one generation to another is significant. It is going to be life-changing to some families. It prompts a cultural shift, because I still remember one generation or two generations ago, money was kind of taboo. Like, my grandparents passed away, and my parents didn't really know how much they have and how much they're gonna be getting, and how they didn't like even have a will, which, but that's Lebanon. That's a different story. But like, the money was such a taboo topic. The fact that you dare to ask your grandparents or parents, what's your wealth? How will that look like? Do you want to plan it? Just means reduces them to, selfish motives. Like, culturally, that is bad to talk about.
Yep.
Whereas, and that was fine back in the days, because what you're gonna be inheriting was peanuts. It wasn't something important that's gonna be changing your life. And I think the big part for why every generation is getting richer than the previous one is because more people have access to education, literacy rates the highest they've ever been. People are learning how to maintain the money, because back in the days, people might inherit, but they'll blow it out. So now we've got this right conditions for it to accumulate generation after generation. And because this is, a dramatic demographic shift in the socioeconomic level of the whole civilization, culture has to adjust to be prudent, because it's a missed opportunity. We're assuming this is a family unit where everyone wants the benefit for their family members, and what is good for the whole family at that point is for that conversation to be held.
Yeah.
Just like you mentioned.
I love it. And just for better or for worse, I'll share kind of, so in my personal situation, here's how I've framed it to my dad. So, and I think this is helpful, hopefully, because when I say talking to your family, to your point, Rabih, I'm totally in agreement. Like, this is a cultural shift. And I think for a lot of people, money is a taboo topic. But I think the way you frame it matters, right? So how I framed it to my dad as he's getting older, my mom, unfortunately, has already passed away. And I've gone to my dad. I'm the executor of the estate, and the person, I've family of 5 kids. But what I've said to my dad, and I mean this genuinely, is I'm not going to my dad and saying, "Hey, Dad, how much money?" Like, I want to make sure that the money passes to me and the kids. Like, it has nothing to do with money. It's, "Hey, Dad, here's how I framed it. Hey, Dad, I want to make sure that this is set up the way you wish now, as you are of sound mind, and that you have your estate plan in place for when you pass away, that this is passing. It could be going to charity. I don't care. It could be going to your dog. Like, however you want it to pass, you need to establish that now, and we need to communicate that about that now." And I've made it kind of selfish for me. I said, "Listen, I'm the executor of your estate. The pressure you put on me, if you don't have this in place after you're gone, is immense. Like, it's life-changing. So I don't care where the money goes. This is your money, but let's talk about it so I understand, and we have it all in writing. So we have all the legal documents in place. So there's no guesswork. There's no battling. There's nothing. It's just, hey, here's what it was. And so do that now. Be talking to your parents and grandparents about that now. Frame it in a way that's like, hey, this is for you. I mean, it's for our benefit. The conversation's for our benefit, but not in the sense of like monetary gain. It's how I can help you execute your wishes.
Yes.
I think that's how I'd frame it.
Yeah,
If
I love it.
Hopefully it's helpful.
No, I love how you framed it, because it is their hard-earned money, and
Yes,
it's like you're playing a basketball game. I know I'm going there, but you're playing a basketball game. You cross a bunch of players, you break some ankles, and when it comes to make the shot, you miss the layup. Like
Yep.
this is how you should frame it. Like, you've worked hard so much for this money your whole life. You don't want to miss the layup at the last second.
Yep.
You don't want that money to go to waste, whether it's going to the wrong people, or it's going in taxes, or it's going just
Totally.
wasted. Just finish.
Yeah. And I'm not going to sit here and say I know the situation of every person out there and their families. I know money, to your point, can be a taboo topic for people. But I think hopefully this can be a reminder. This is why I wanted to bring this topic up, is hopefully it's a reminder to say, if you're out there thinking, man, I should be talking to my parents about this, or if it's kind of that urge or that back of your mind thing, I think bringing it up and framing it the right way can be super impactful. And not in the sense of like, oh man, you're going to get more money. It's just, again, I think it can actually bolster relationships. It can actually help strengthen relationships when you're approaching a topic like this and doing it from a genuine place and just saying, let's all get on the same page of how we want this done in the future. And I think I've noticed that in my own life. It's really helpful. So that was the main reminder, I think, for this topic, and just the mind-blowing nature of the size of this amount of money that's transferring. I agree with you, Rabih. It's going to be cultural changing. Possibly. It's going to be wild over the next 15, 20 years.
A couple of generations from now, we're all going to be trust fund babies. Just wait.
Yeah, no, so honestly, I mean, the wealth in America is just mind blowing. Okay, Rabih, any final thoughts, words of wisdom?
I love it. Honestly, going back to the first topic, I love that topic. I think it's one of my favorite topics to talk about.
I'm sure it'll circle back. We'll keep talking about it. I loved it as well. I always love this show. Everyone, thank you so much for listening. If you are enjoying what you're listening to, we would love you to go on, leave comments, rate the show. Helps us spread the word to more dentists. We would love that. If you want to talk to us, dentistadvisors.com, click on the yellow button, book free consultation. We'd love to hear your story, see how we can help you. But as always, thank you so much for listening. Rabih, thank you for being here. That was our 2 cents. Have a good weekend. Bye-bye.